Hey, it's Gio from Strategic Edge. Real quick, I just want to go over the back end settings panel for the Stratus engine. So hop into that from your little gear wheel here. I want to preface this by saying I don't really know how electricity works, but I sure use my lights every day, and I enjoy uh, you know, all the benefits of it. It, but it doesn't mean that I really get it, right? And this can totally be that way. If you don't care about uh, this giant settings panel, you put it on your chart. I set the defaults to, what I'm already using and I've tested and, back and forward. Um, I know odds are you're just fine. You don't need to change anything. But if you're a tinkerer and you want to, kick the tires, try and see if you can't, optimize your settings for your instrument, your time frame, whatever the case may be, I want you to be able to do that. So, up at the top here, what we're actually looking at is the BW calculation. We use trading legend Larry Williams, his percentage of range calculation, which then we, break down into some averages, and that's how we um, really kind of figure out where we're at in terms of momentum, accumulation, distribution, all the things that we're looking at on the BW, which we'll cover in another video. But we do use that calculation in the background of the Stratus engine for um, certain um, signal plots, the bonus signals like divergent peaks, Willy soup. So it factors there. It also factors into the calculations for clear skies. So really, in all honesty, I wouldn't touch this because, you know, this is the BW that is tried and true that we've been using for a long, long time. I I wouldn't recommend changing that part of the calculation. But once upon a time, um, I was changing everything constantly, looking for optimized settings. So I did keep all of those user input parameters live and available for, there may come a day where the market shifts substantially and, we got to retool a little bit. But, in the here and now, and for, uh, you know, the past several months, I've seen no reason to move away from these optimized settings. This part, these TS settings, all have to do with the turtle soup setup that we're using for the Willy soup bonus signal plots. Um, so if you know anything about turtle soup, general rules are 20 look back period. We're looking for um, a new, swing high or swing low. Cannot be uh, less than 4 bars since the previous new higher low is created. Um, this deals with how far back into the range it has to go. This is how many bars I'll accept it as valid. Now, you also need to keep in mind, traditionally there's turtle soup plus one. Um, but in the case of Willy soup, we're looking for the additional confirmation of the BW, right? So um, to allow for that to play out and to happen, I did extend the bar count on that. So just something to consider. These deal with divergent peaks. That is almost exclusively, a derivative of the BW momentum oscillator. What I'll tell you is that what we're really looking for is for divergence, right? Divergent peaks means that we see peaks forming on the BW, and those always correspond to, price action. So then we compare those peaks. Did they make a higher high on the BW? And did it also make a higher high in price? Or did it make a higher high on the BW and it made a lower high in price. Anywhere we see, associated divergence like that, um, and in some cases, I would almost interpret it as a hidden divergence because there's almost no way to see that with your eye. Only way that we actually were able to substantiate it was through the calculation. But once my hunch was proved correct about what's really happening there, and I will say that in that trade setup, the divergent peaks, it's not always that leg that it fires on. I use it more as of like a warning signal, almost like a yellow glow that, there's a high probability that it may not be this leg, but that next one, that starts fading the main trend, it's probably got some legs to it. Probably a good one to get into. Um, the golden third. So this is really a fast HMA, a whole moving average. We utilize whole moving averages in the SkyMap system because they are the least lagging of all moving averages. Um, so, we before in years past, did testing with uh, exponential moving averages and simple moving averages. What I can tell you is that I never found them useful because all I was looking at was something that I could tie to historical price. Whereas we find that the whole moving average, it's really, really responsive. I mean, it's very quick to say, nope, we think it's moving the other way. So we utilize lots of different HMAs to kind of confirm trend on various things. This one is utilized for the golden third setup, which was, we're looking for a move that's already underway. And then we're looking for, maybe a little choppy period. And then that golden third usually tells us when there has the potential to be a more substantial price movement. The These are the actual cloud HMAs. So for the base cloud itself, um, like I said, I've tried so many combinations. And back tested and forward tested lots and lots and lots of different cloud combos. For a long time, we used the 35 120. But I can tell you right now, I really, really believe in the 1550 120. I think that in most cases, it's painting the picture really well. So, I mean, you can always play around with that. Hide developing cloud. So, um, there's always kind of that thought like, oh, I got psyched out. It was showing me this, and then I took the trade, and then by the time that bar closed, that signal wasn't even there anymore. It repainted. Um, so if you are one of those, if you have that fear, if you feel like, oh my God, I'll regret making a decision based on something that later isn't that, that then hide the developing cloud, and it'll only ever tell you what's happened once the bar closes. For me personally, I'm an intraday trader. I am trading on a 1 minute chart a lot of the time. I'm making decisions fast. Just because there's 15 seconds left to go on a candle, I know that there might be some danger in me assuming that it's going to close where I think it's going to close. Um, I'm very experienced at watching price action develop on the instruments that I trade, so I have that level of confidence that what I think I see developing is going to come to fruition. If you don't have that, you might want to hide the developing cloud. You might always want to wait for the confirmation. You know, that's a personal preference. That's something you're gonna have to, kind of look inward to make sure that your settings and your parameters fit your personal trading style. I keep the default set to off because I like to see the developing cloud. The cloud delta threshold deals with the delta squeeze bonus signal plots. 50 is more than enough for most instruments. Where you're going to find that 50 might not cut it is like, say, you're trading NQ on a very volatile day during the New York session. Okay, then your cloud delta, the space between the top and the bottom, or the top and the bottom of your cloud, it could be so wide that it's not going to register in the delta squeeze calculation, and you can always widen that out if you think you need to. Um, Once again, personal preference thing, but like I said, 50 should catch the majority. Unless, maybe you're on a really big time frame. You're trading the hour chart on NQ. Yeah, 50 is not going to give you many delta squeezes. That's, the average cloud delta is going to be far greater than that. So, you'll have to feel that out. Super trend ATR factor, I keep that as a one because typically I'm using that super trend ATR line right there as a cloud trade target. And I want it to get hit. I want it to get hit. I want price to get there, right? When I'm utilizing it, a lot of the time I'm not, but when I am, that's my objective. So because of that, I try and keep it at one. I mean, two works as well. You gotta be willing to be in the trade a little longer. Um, but two will get hit. But uh, uh, I've said it, numerous times, but I'll tell you again, base hits get you paid. So, um, we want our targets to not be overly ambitious. We want to make sure that they're easily attainable, that a little bit of momentum is going to get us across the finish line. Only shows signals with super trend. Yeah. You can turn that off and get a ton of signals. I don't recommend it. This really makes sure that it's in essence making sure that the bonus signals that plot on your chart are always in alignment with the current structure of price, right? So if if price has been making new lows, then we're only going to see bearish bonus signal plots. Vice versa. If we're only been making new highs, we're only going to see um, bullish bonus signal plots. We do track fair value gaps. So fair value gaps are, if you're not familiar, a fair value gap is a three candle pattern. So you see this shaded area right here is a fair value gap. First candle, second candle, big move away. Third candle, that wick, the space between this wick and this wick is a fair value gap. A fair value gap really is just price delivery imbalance. And if those words mean nothing to you, I'm going to show you a volume footprint chart. Volume footprint is showing you market orders, all the market orders. So anytime somebody smashed a market sell, a market buy, their volume gets logged. Okay. So when we see this fair value gap and then we turn on a volume footprint, it's completely substantiated. What you see is inside this range, there was way more buyers than there was sellers. Way more buyers than there was sellers, right? And because of that, there is a price delivery imbalance, which essentially means that the market, due to auction theory, if you subscribe to that, market maker theory, they're going to want to come back and offer price delivery in that zone at some point. It doesn't have to be imminent. It'll happen when it happens. Um, but that's why we track it, is because price is likely to gravitate back to offer selling. And when that occurs, it's a good idea to be a buyer. That's all. Same thing on a bearish one. We find one of those, yeah. So these bearish fair value gaps get tracked. Price ticks up into the fair value gap, which is substantiated because you can see here on the volume footprint, far more sellers than there were buyers in that time period, right? So it would make sense that they would want to come back, offer buying in this range, and that occurs, price retreats back to the prevailing trend. So we do track fair value gaps as solid potential entry points. You know, maybe you didn't start watching the chart until here, and then you see that you got an imbalance. So you do have a potential entry to still make it into this clear skies bearish trade, right? Uh, let's get back into the settings. Oh, no. Okay. So we do track fair value gaps. We also track change of character and break of structure. So here, let's find it. Break of structure. Let's zoom out. Looks like this is our change of character right here. So up until this point, we were making higher highs, higher lows. Then we make a lower low. So this is a change of character. We went from having an overall bullish sentiment to an overall bearish sentiment. Then, so this price leg becomes our, this is the price leg that had to change of character. We get a retracement. Here we have a little pivot, and what happens? We come back to go lower than that pivot, and now we have broken structure, making new lows. So now that becomes the new range. We retrace into the range, and every time you're making one of these retracements, I mean, it's not rocket science. You drop a fib on the thing, you see it for what it is. You're typically coming back somewhere around 50 to 70 some odd percent. Okay, that's typically what, a smart money trader would consider to be the optimal trade entry, somewhere in that range, right? So when that happens, this is my OTE fib right here. I get that retraced to right there. I'm back in a bearish cloud, so this is a bearish re-entry, and then I would go all the way to that TP down there. So that would be a 2-to-1 R trade if I enter here with my stop here and my TP there. And those things are kind of easy for us to spot because we track change of character and break of structure. Okay. Um, I personally don't show the support and resistance lines. Feel free to turn that on. I left them in for support and resistance traders. If you like that, it's for you. These are your color settings. So if you do not want to have a dark themed chart like me, then obviously you want to change all of these light colored things, the whites and stuff like that, the grays maybe even, to different colors that are going to pop on your chart a little bit better. Um, so that's fully customizable. Same goes for the super trend. All of the bonus trade signals, your fair value gaps, your market structure annotations, and down at the bottom are the controls for your glows. So you can change the colors of your glows, you can change the intensity of the glows, and you can change the overall size of the glows. So if you want those things to really be unavoidable, super obvious, that option is available to you. In most instances, I do think that the one is just fine. And then you'll find as you go to bigger time frames, it naturally grows anyways, the glow width. So that is all of the back end settings for the Stratus engine, and we will catch you on the next one.